Good morning, everybody. Welcome to the Flow Show, Thursday, the 15th, day after Valentine's Day. That's what it is. Hope you're doing well. Morning, K-Man. How you doing, mate?
Hey, good morning, Ryan. Yeah, all good, man. I hope you too. Hope you had a nice Valentine. And welcome to Kjell Christiansen from Thailand. Wow, a warm welcome, I guess. But that's nice to have people from Thailand tuning into our show. Welcome. Yeah, all good, mate. Let's rock and roll. A lot to happen today.
Yeah, welcome. Thailand, lovely place. Went there in, well, unfortunately, I was there just before the tsunami, a couple of weeks before the tsunami. So, yeah, it was a bit of a time back then. But, yeah, welcome to the Flow Show. Good to see you from across the waters. I hope you enjoy what we put on here. Right, let's get stuck into it. Where should we go first? Let's start off with some data, shall we? Japan GDP not looking too hot at all, coming in worse than expected on the quarter, down 0.1%. Not looking too hot on the year either, down 0.4%, though not as bad as previously. Some of the other numbers not looking good either. CapEx, that's investment, down 0.1%, was expected to rise 0.3%. Their version of the PCE price deflator thingy coming in at 3.8%, softer than the four expected and prior 5.3%. Private consumption soft as well. Not very good numbers on GDP. Business spending, which is not on there, was also a negative, down 0.1%. This is something that obviously Kishida wants, a bit of expansion among businesses, but it's not coming yet, even amid some potential tax cuts and incentives that are going to be offered. That also doesn't look good when we're talking about the wages front as well. Businesses aren't spending on themselves. The last thing they're going to spend on is their workers. So we just need to keep an eye on that for now. The Japanese, one of the Japanese economic ministers popped up saying consumer spending lacks strength and capex is taking time to realise. The government is aiming to achieve wage increases that surpass inflation, leading to consumption growth. It aims to boost potential growth rate by promoting the domestic investment. Aims to realise the virtuous cycle of wage increases and economic growth. That's the whole big plan, and those GDP numbers aren't it. But you might expect the yen pairs to have rallied on that, i.e. yen weakening on those numbers. It didn't. We've actually seen it strengthening this morning. A bit of dollar in there, but from the yen side, there was a sources piece out from a Japanese official saying that they are at the last stage of beating deflation and that Kishida could soon announce the end of the deflationary period. Why is that big news? Well, they've been in this deflationary period for over 30 years. So calling an end to that is going to be a monumental shift for rhetoric in Japan. Now, the reason why yen pairs have dropped, the yen's gained, is because officially moving out of deflation into an supposedly inflationary environment is perhaps good news for the BOJ, for them to start tightening policy and ending easing. However, look at the scorecard as we sit here today. We've got Q4 growth looking soggy. We've got inflation, which is edging back, as UAE has told us it will be. So we need to see that picking up. And we still don't know what's going on in the wage situation. So the perfect scenario for the BOJ is strong growth, rising inflation, and decent wage gains. At the moment, we've got question marks over all three of those. So it really is it's in a bit of a tightrope walk, this one for the BOJ at the moment, going into spring and these wage negotiations. I don't know if you've heard any bits and pieces yet from those. I know there was one of the wage negotiations happening yesterday and today. Kay, have you heard?
I haven't seen anything on the news wires myself. I did not really see anything spring out either. Yeah, there's the problem the problem with the BOJ, and I've been saying that since actually the end of Kuroda's tenure, and then when Ueda came in, is they really have to use every opportunity and every window to bring it back out of negative territory. I don't think that the whole picture is really changing. I do think that they are going to take the rates out of negative, but all these numbers are really not favorable to start a real hiking cycle. Imagine how are they going to get, and then taking into consideration it's Japan, it's not the US with a very dynamic economy, whether it be up or down, and even not the old continent's economy, which usually goes a lot slower, and we can see that out of the numbers as well. Where the US is running at +4, -2 historically, and then the Europeans are like +0.2 or -0.1. But in Japan, this is, and that window seems to be closing very, very rapidly if you look at the numbers for normalization now. I think they will, but imagine those wages coming in below 3.8%. That is not going to help them at all. And I think the calling an end to deflation is half giving the green light to the Bank of Japan to hike rates, and but the other half, I think, is very politically driven as well, because we know that the LDP has internal issues with quite a few of their members actually, and they need some to send some good vibes to the Japanese people, you know, some positive vibes. So I think it's half 50-50 the reasons for that. But yeah, I mean,
It's a bit of a knife edge, isn't it? This close to, you know, when they get these wages, and when the Bank of Japan is expected to start tightening, it's a bit of a knife edge, all this data. You know, what if inflation keeps, you know, we get to March, April, and inflation is, you know, under 2% and trending lower. Sorry, just yeah, inflation is trending lower, and like you say, those wages don't come in above 4% or above the prior numbers. You know, that's the market's gonna crack the bed on that, isn't it?
Yeah, yeah. I'm not going to say wages are not going to rise as much as they could be expected due to the capex, because it's a double-edged sword, right? You could say like, oh, they're perhaps spending a little less than on the rest, and then they are going to give the wages. There is an argument for both sides, right? But it could be that that capex is a harbinger of what's to come in the wage negotiations. Anyway, we will see. I think the most important one, Rengo, is not expected before March. We've got smaller ones going on right now. And we will see what comes out of those. I haven't seen, as I said, I haven't seen any numbers yet. I will check on the Nikkei also what they say. But yeah, this window is it was wide open for a year. They could even use the other central banks' rapid rise in interest rates as an excuse to just take their own above zero, and they didn't. And now there's a big risk in those data. There's a big risk that they just can't go as far as they may have expected originally. So yeah, there you go. There's the Japanese automobile workers. We haven't seen that. That's a quite big one. Electric and electronics, yeah, could be a big one too. But yeah, they're all relatively important unions. But yeah, I haven't seen anything yet.
Yeah, Rengo's the only one that's got an official date of when they're going to release their tallies. So the others are just as and when they come, if they come.
Yeah.
And they might all be waiting on each other to see what the numbers are like before then going back to the negotiating table.
Yeah.
This is a headline risk that we're up against at the moment that could pop up anytime during Asia hours. So if you're trading the yen, make sure that you got your eyes peeled into these headlines that may drop, because they're going to be big movers.
It's going to move. Get wages above wage hikes above 4%. And yen has been and will continue to be a relatively volatile currency compared to others. And I do think that that is going to be a big mover, perhaps a bigger mover than when Bank of Japan will effectively take their rates from -10 BP to 0. So because it will be driven by this. This is the driver coming up. So yeah, it's going to be a big mover. Imagine that we get weaker than expected wage growth. I wouldn't like to be long in.
Yeah, no, exactly that. Okay, right. Well, let's move on from there over to Australia. Get a shot of that. Some soft data from those guys as well. The employment change rising just 500 people versus 26.4 thousand expected. It did turn around the drop from last month, but that miss of expectations doesn't bode well. Bit of a switch around. Full-time employment up 11k again, turning around the negative last month. So a bit of a positive, but not looking overly strong. The employment rate went up more than expected to 4.1%. That was even as participation rate missed the expectations of 66.9. So that stayed unchanged overall. So that employment rate was not affected by the participation rate. So that's a more negative 4.1% for that number. So not overly good for the Aussie dollar. Swaps over there have now see the first RBA cut coming in September rather than November previously. So getting a little bit more dovish in the pricing over there. RBA's Bullock, I think was speaking in Parliament, said it's they're in a good position to get inflation down in a reasonable amount of time. And then dropped this interesting comment talking about central bank coordination and how they all feed into each other. Said rate cuts overseas will have implications for RBA policy. So there you go. Over in Sweden, Riksbank Sweden says we should have seen the interest rates peak by now, or peak now. Some probability that we can cut the rate in the first half of the year. Any cuts, though, must be made with caution. Coming over to the BOE, BOE's Bailey says the latest inflation data shows more downward pressure than we expected. The latest inflation data is good news, and that downward pressure on inflation is quite broad-based. Services inflation is not compatible with the 2% inflation goal, that high number that we got yesterday. The latest wage data showed quite a marked reduction, but not as far as we thought. We're now seeing signs of the beginning of a growth pickup. An interesting comment, which I'll move on to in a moment. He says inflation will be coming down to target by spring. GDP in the UK, he better pick up in the Q1 because Q4 was absolutely abysmal. Q4 GDP there coming in minus 0.3%. So we have got a technical recession, not a complete collapse in activity, but as far as the economist goes, it's a technical recession, 2 months of negative growth, but that growth worse than expected year on year, obviously coming in worse as well. The December numbers, which don't really mean much because they're now within that GDP number, came in at minus 0.1%. So not as much as expected. That probably saved that quarterly number from being even worse. But there was some green shoots among all the data. Firstly, business investment here picking up quite nicely, 1.5% on the quarter. Year on year, it's up 3.7%. So there is signs that despite these negative numbers in GDP, on the ground, businesses are still investing, which is good news, and maybe that will feed into a more productive Q1. Industrial production for December, again, these will all be within these numbers, but for the month themselves, looking fairly positive, all green on those numbers there. Trade balance as well, improving, the deficit improving by a little bit, just over £1 billion. So that's going in the right direction as well. So yeah, there are pluses and minuses. Everyone's having an argument about what the definition of a technical recession is, and is it good, is it bad? A lot of people brushing it under the rug. Bailey's brushed it under the rug with that comment saying we are now seeing signs of a beginning of a growth pickup, but it remains to be seen as to whether that comes in Q1. Over at the ECB's McClure says we're confident in sustainably reaching our 2% goal, though he remains open-minded about the policy rate path. The short-term outlook for the euro area is stagnation, and we're yet to see the full extent of lagged effect of ECB hikes. ECB's no bit of an understatement. This one says there's a lot to do on the German economy, and that the economy may have contracted in Q1. It'll be a shock if it hasn't. I can tell you that. ECB's to cost says we still need some time on the exact timing of a rate cut. We had the Grand Owl out herself this morning saying data continues to signal subdued activity in the near term. Wages are becoming an increasingly important inflation driver. She said the ECB's forward-looking wage tracker continues to signal strong wage pressures. Doesn't want the ECB to make a hasty decision, but says the ECB has succeeded in anchoring inflation expectations. Germany confirmed the cut in 2024 growth down to 0.2% from 1.3%. That was touted yesterday. It's also expected to cut GDP for 2025 to 1% from 1.5%. Also, the DIHK, which is the German Chamber of Commerce, expects the economy to shrink by 0.5% in 2024. The EU Commission has cut Eurozone GDP growth forecasts. Also, 2024 now seen at 0.8 versus 1.2% previously. Kate, I want to ask you one question because something's striking me. I'm sensing a lot of complacency coming from some of these central banks. Bailey saying that inflation will come down to target by spring. Lagarde saying she's succeeding in anchoring inflation expectations. Are they starting the victory laps a bit too early?
Well, we have to note that the inflation dropped more than 50% from the tops, right? So in that sense, they can somewhere say it's thanks to them, where I personally think not at all, but it's just a matter of how markets function and supply and demand. And are they starting the victory laps early? I think the risk in what Bailey said is that those green shoots, although if you look at the manufacturing industrial IP numbers a bit across the let's call it the old continent, UK and Europe come together, you know, this side of the world are seeing a bit of upticks from bad levels. I even think, was it not the German numbers out a few days ago that even crawled back to a small plus? That is perhaps something that they want to hang on to. I think then for the Eurozone in particular, I think Lagarde anchoring inflation. Yeah, they are the rates are above the inflation level. Perhaps that she's sending out a bit of a hopium message somewhere, but then at the same time she's saying like they don't want to be too hasty to start cutting. And as we have been saying for a long time, and you said it like straight from the off, that's the side that they want to make a quote unquote mistake, but it's not really mistake, is the wrong word, but to stick for longer than what should be the norm historically. Victory laps too early. I think if the victory lap may be too early for growth, because this could be a year where growth actually stabilizes, or even small negative. Even in the States, even if the Q1 is still is still showing very decent growth, and we will have the Atlanta nowcast, or now Fed, or Fed now, or whatever they call it, out this afternoon as well. Those 25 revisions before the actual number hits. But yeah, I think on the front of growth, they are taking a risk. On the front of inflation, perhaps less so. Sticky, yes, but it is still coming down, right? So yeah, I mean,
Well, that's actually a point I disagree with at the moment, because it's not coming down anymore.
no,
Particularly, I
not
know
anymore, but it has come down a lot.
it's come down a lot. But look at as I pointed out from the US, we hit 3%
Yeah.
back in June last year, and it's gone sideways. Here's the ECB rate, or the Eurozone rate; it's going sideways. The UK inflation rate has gone sideways for 3 months now. Now there is, from that CPI number that we saw in the UK, there are negative month-on-month numbers. The underlying, when you look at the baskets individually, there are signs of disinflationary pressure. Yet, granted, but the same signs are in the US. Yet we haven't gone lower in 7-8 months. As you can see here, the Eurozone or Europe tends to lag what's happening in the US in an inflation environment. That's going so. I think that the complacency is going to be, and this is the risk for the central banks, that inflation does go sideways, which put them into a sticky situation. Do they keep higher for longer? Will they be forced to hike again?
No, I mean, to be honest, forced to hike because of this, I don't think so. I really, well,
I think the US,
with growth where it is in the economies now, I don't believe for a second that they will be forced to hike if inflation continues to go sideways. Not if we start to spike to 6-7% again, but do we see that happen to spike to 6 or 7% again? What is going to be behind it?
Yeah, no, I think if you line them all up, I think the US is most at risk of that, because their economy is doing pretty well. They've still got higher wages. They've still got a decent consumer. That will bring inflationary pressure. So they're more at risk of seeing inflation meaningfully going higher. As for the rest, the weak economies should keep inflation down, but does it fall? So I think the US gives more risk for hiking, even if that risk is maybe 10-20%, whereas it may be 5% for the others, but the risk is still a risk. Yeah, I think that the sideways action is what we've got to look for now in these inflation numbers, because that's going to determine cuts more than anything. And if we have to start pricing out cuts in the middle of the year, that's going to be another reprice we have to go through, because then everything will get booted later in the year. But yeah, it's all on a knife edge.
Yeah, I agree, it's on a knife edge, but I don't believe ECB will hike. I agree with somewhere with Ali that they can't afford it. Especially if you look across what's happening, especially in a country that should be the engine of Europe. In Germany, that's not going to be. I think it's a no-go for ECB to hike rates unless we're getting like another black swan event or so. And okay, it can always happen. I mean, the virus can flare up again, and the economies come to a halt, and prices going extremely higher. But that's going to be a real catastrophe scenario if that happens. And assigning a percentage to it is virtually impossible. But I mean, that's like less than 10% chance. In the US, okay, I mean that could happen. But also don't forget that we are in an election year, right, over there. What central banker wants to hike in an election year, right? So that will start to come into consideration as well. Yeah, the question is, and nobody actually ever asked that to a central banker during the press conferences, to what extent do they want to keep positive real interest rates? Positive real interest rates meaning interest rate minus inflation, right?
Yeah.
It's been below. It's been negative for a while in many countries around the globe, which is not really great. It's not a great situation. It's better to have a slightly positive rates, because then people can have because banks are following that move, and then people can have interest on their savings at least. So to what extent do they want to keep positive rates, and how much? Because I mean, historically, it's always been that the real rate should be at least 1.5% above CPI. So there is perhaps a risk somewhere if they really want to keep positive rates.
Yeah, exactly. Just quickly to Ali, you're asking all these questions, you know, judging between what one side of the market, another side of the market, you know, talking about inflation. How can, you know, if inflation goes up, what does the market do? Okay, put it into simple terms. Okay, all the opinions to a certain extent don't matter. Okay, what the market thinks, what the bulls think, what the bears think doesn't matter. Okay, you have to know what the central bank thinks first and foremost, and then you have to see whether the data is playing ball with what the central bank thinks. Okay, if that's happening, those are the two constants you need to look at. Okay, because whatever the market does outside of that, at the end of the day, it's got to always come back to what the data is doing. So if the market's overly bearish, overly dovish, central banks cutting, like we've seen, the data hasn't proven that theory. So they're wrong. So you can trade that. Now, you've got to trade it carefully, because they can be wrong with far more money than you or I have got. So you can't blindly trade it. But you can set up your trades for more longer term if that's the way you see it. So, you know, we can have these conversations about what the banks think, what this analyst says, what that analysis says. At the end of the day, make your life easier if you're getting in a bit of a mix-up or getting a bit confused by it all. Know what the central bank's doing, know what the data's doing. That's the hard evidence you've got, where everything else is conjecture. And that's how I do it. That it keeps things clean in my head, because you can get stuck into the arguments for this, that, and the other. Listen to the hard evidence, data, and what the central banks say. Even if the central banks are wrong, the data will make them wrong, nothing else. Right, moving on to the Fed. And Mr. Powell had a closed-door meeting with Democrats after the CPI data, apparently. This isn't something top secret that some have been writing about. They can have these closed-door meetings, have had them previously. The Democrats are the incumbent government, so it's their right to have a chat with their central banker. He said, though, that the inflation data was consistent with what they had been anticipating, and that the Fed would look to the upcoming PCE report to give them some more intel. So no direct comments on the CPI in terms of you know, why it was hot or not, but a bit of a brush off really to say that, yeah, we were expecting that, no big deal, and the markets has sort of taken that to heart. We've washed out quite a bit, or some of the moves that we saw over that CPI. Fed's Goolsbee says even if inflation comes in a bit higher over the next few months, it's still consistent with our path back to target. So again, a little bit of brushing it under the rug. He doesn't support waiting until inflation is already at 2% on a 12-month basis before cutting rates. So that means you want to cut on the way to 2%. Rate cuts should be tied to confidence in being on a path towards our target rate. That said, CPI data yesterday was puzzling and is something he is watching. But he is totally clear, another bit of complacency, that inflation is coming down. And then he offered this tidbit of forward guidance. Let's not get too flipped out about yesterday's inflation data. Okey-doke. Fed's bar, need more good inflation data before rate cuts. We're on a good path, but very early to declare a soft landing. Treasury Secretary Yellen out as well, saying that the market reaction to CPI data said it's a tremendous mistake to focus on minor fluctuations. Bank of Canada is going to halt its QT program within months, so says RBC. Bank giving their analysis there. However, a date for your diaries. BOC's Gravel is to deliver a speech on QT on March the 21st. So let's see if RBC knows something we don't. Jobs Watch, Continental are to cut 7,150 jobs, around 3.6% of the workforce. Morgan Stanley is laying off several hundred in its wealth management division, and Cisco, who we spoke about last week, confirmed they're going to cut 5% of their global workforce, which by my calculations about 4,200 people. So now we're just getting job cuts into the thousands where they were hundreds before. We've been monitoring this. One area to watch for all these numbers coming together is the Challenger, Gray and Christmas job layoffs report that we get in NFP week, usually on a Wednesday, about 12:30 UK time. That is where you'll see all these notices of intention to lay off coming into the numbers. So if they start going up through the roof, that's going to send a bit of wobbles into thoughts about the jobs market. So it seems the snowball is slowly getting bigger and bigger. When it turns into something for NFP, no idea, but the trend is pretty clear at the moment. Two last bits. US investors apparently are switching their ETFs from those that invest in emerging markets to ones that exclude China. That's according to the F.A.C.E, so further movement out of US investors from Chinese investments. We'll see how the stock market does when it reopens in China on Monday, whether they're going to keep it propped up or whether we're going to see further selling and the dead cat bounce dissipating. Geopolitics, there's been an incident in Taiwan where two Chinese fishermen have unfortunately died after being pursued by the Taiwanese Coast Guard. There's lots of shenanigans going over there with Chinese fishing vessels fishing where they like and upsetting everyone. But this incident obviously has brought some strong condemnation from China. And the fact that it's Taiwan involved in this just raises the stakes a little bit. So just keep an eye on that one. Okay, anything from you, mate?
I think you covered a lot already. Yeah, I think we covered everything. The rest is more like opinion stuff and not really relevant to the actual facts that could make markets move. So we can move on to something else, to prices also.
Yeah, cool. Well, where I'm going to start is S&Ps because we've had the, we're speaking about this. This is now looking like the decent trend refresh that we've been lacking in this period since the last decent trend refresh. As you know, this week I've been talking about this. We haven't had a decent pullback for those dip buyers, those patient dip buyers to get their teeth stuck into. Well, now it's looking more and more likely that some of those have moved off the sidelines. They've taken us back above 5K, but we don't know what it's going to do from here. We're holding 5K at the moment, which is a positive. I want to see what happens if we get up and test the highs around 25.30 and then possibly the highs around 50.51 again, if we manage to get that far. If we can't do that, then we're probably going to come back under 5K. This line will probably get washed out a bit. And it could be that we're in for a bit of sideways action because these buyers down here aren't going to give up too quickly if the price comes, back down to around this area. If we break below there, then there's something more bearish happening. These tops are going to solidify. So at the moment, we need to watch this range. Bit of a wide range, 50-50, down to this low and down to this break point here. this is going to be the decider in here. What happens? We either go sideways for a while, we break up, or we're going to break down. So again, another one that's on a bit of a knife edge at the moment. But for now, it would suggest to me that maybe we're going to have a look up towards these highs and potentially keep on going. Similar price action to what we saw here after this trend refresh. We had a dip, buyers come in, we go on, and then eventually we break up to new highs, and then we keep going and we're off to the races. So for me, happy to stay long. I did get tipped out my 5,003 buy that I got in here, rather, on this break above, and then we turn back down. But I've still got my longs down below, so I'm still happy to stay long. It's still a decent trend up. There's no real signs of that breaking at the moment on the wider picture, so that's what I'm focusing on for now. But I'll be watching the price action up around here. Dollar has come off for a little bit. This one's probably following yields as well as that news over there. We've been knocking around this 150 level, had a little poke underneath, which sort of cracks the egg a bit perhaps. Buyers would have wanted to see this holding a bit more solid than it has, but we're still there, so it's not out of the woods yet. On the vol front, things have dropped down. I'm looking now. Dollar yen was up in the 8% for the last couple of days. It's now 7.68%. Euro dollar 5.5%. That's a sort of fresh low for recently. Cable as well, under 6%, 5.98%. So after all these data points, we're seeing the vol come off a bit, which is not good news for us. We do still obviously have data today to come, but vols are coming off a bit, so things might slow down. Euro dollar on the creep. I was saying yesterday, we've got a bit of a battleground between 107, the figure, and this 107 2025 area. Well, it's looking like it wants to make a decision because we're back above there and we're holding it as support now. So it's technically for buyers and longs, that will be me included, it's looking a bit more constructive than it was sitting in this box. But a lot of work to be done yet on this one. We need to 107.60s. We need to get above next, and then we take on 108s. There's a long way to go before we start turning around this trend that we've seen all year. So a lot of levels still to go. This is all short-term stuff. It's encouraging if you're buying off down here, but we're certainly not out the woods by any way, shape, or form for the moment. Cable, quick look at that one. Again, probably the dollar influences stopped this one from really crapping out this morning. You've seen more of a move in euro sterling than you have in cable. Important levels down here into the fib and the 125 area. So this one, another one, not out the woods, not showing this move here is similar to what we're seeing this morning in euro dollar, just on a bit of a wider, larger scale because it's cable, bit more vol. But here it's not looking, it's looking very dead cattish. So unless we get back above 126, this one is still going to remain looking a bit on the weak side. But as I say, a lot of dollar influence in this one, more so than others. Euro sterling, as said, we're going to have to wait a bit longer for the 85 break. That could happen maybe tomorrow when we get the UK retail sales. If they're super bonza, then that might wash out some of the negativity for the GDP. I would think if we get good retail numbers and a move back down to 85, that will be one that I'll likely pile into because the retails aren't as big a number as the GDP and everything else. So 50 pips, if we round here into that, that's a decent stretch point for me. So finally, I might decide to pick back up some 85s, add into my core long already, if it's seen, of course. And if they're poor numbers, well, we're probably going to take on this 85.70, and it will probably signal that we've got a pretty good bottom down here, which is already looking like a 3-week bottom. So that's a good length of time for a price to stop falling, at least. But we shall see. We shall see. Okay, you want to grab it, mate?
Yeah, I got a few things I can show for people asking about Swiss, and then what else is there? Just scrolling back through the chat. Yeah, Swiss is the main thing. Then we got take me a quarter of an hour to read what Ali has put on there. Okay, Swiss. Yeah, gold. Yeah. As I was saying yesterday, this trend line here, these levels of activity here, the what is it? This 61.8 here, and then if you look at the longer term, the weekly cloud here, well, it did work, and the dollar Swiss is correcting together with the rest of the dollars. But also a bit on its own, we're seeing a bit of rejection of this zone. So this is the zone that we watch now for the when the data deluge will come out this afternoon. So on the downside, we've got this break level. Yeah, I spoke about that for weeks and weeks and weeks. That has broken, but we are very close to retest. So what's going to happen this afternoon is going to be relatively important. Yeah, we've got the retail sales, which are expected to come in slightly weaker. Some strategists are looking for a little weaker than the expectations, actually. And then we got the Philly Fed, we've got the New York Empire State Manufacturing Index, and then a bit later on, we've got the manufacturing and industrial production, and I spoke about that just a bit earlier. That in some parts of the world, those IP numbers are starting to tick up and seeing some green shoots. Well, let's monitor what's happening in the States, because that, I think, is going to be a pretty decent data dump this afternoon that we are going to get for the future direction of the dollar, or let's say the immediate direction, at least, whether we're getting renewed strength of the dollar or whether we are consolidating, or even the dollar getting a bit of a slap after having broken some levels earlier this week. So 88.20, 87.90, I'm just looking at those levels. And then here, I think 87.60, 87.5, that is where we are going to have to see whether the dip buyers are going to step in again. Okay, you can see that we have a bit of activity there as well, trying to decide whether we were going or not. Well, we did go. So any downside activity for those who are short Swiss, at least, but also for those who are short dollar Swiss, who sold the rally short dollars. This is the area where we should really pay close attention to. 87.5, 87.60. Okay, that is where this plays ball for another leg higher or not. All right. If that wouldn't hold, then I think we are at risk for a deeper correction, much deeper correction, actually. My overall view on the Swiss hasn't changed. I still am relatively biased short Swiss, or for a weaker Swiss, but I did reduce a lot of positions on the crosses yesterday and into today as well. And I'm nursing my dollar calls in the dollar Swiss. I've still got some long-term 87s running, which I also hedged a fair bit of them, or at least a decent percentage. Up around those highs here, I've been selling anywhere between 60 and 80. I've been increasing my hedges because of this zone that I was monitoring yesterday and still today. Okay, so these are the levels to the downside. Without wanting to look ahead too far, as I said, this is going to be my big zone. If that would ever break, I'm not sure if I want to keep anything short Swiss, but the fundamentals are still there because we also yesterday had, was it yesterday or this morning we had this morning's PPI was also negative in Switzerland. I still think PPI is a bit secondary and can have an impact later, but it's not something I really base my day-to-day trading on, to be honest. All right. So we've seen the same thing in other Swiss pairs. All right. CAD Swiss is one. I told you about the 200 DMA. I told you about the 50%, and we went close to, and now we are correcting as well. All right. There's still, I would say, part of a normal correction if this move needs to continue, but we can also not look aside some trends that are still in place, I would say, and we are going to need to break levels to continue to go. All right, same in all Swiss pairs. Okay, don't forget also that we've already done a fair bit of traveling for a week at Swiss. I was saying about this 95, 15, 20 zone on the Euro Swiss. Well, we didn't get there, and now we are back or we at least went back to the prior high. If that would hold, it would be very positive for a test later on of the 95 3/4. But we will see. Okay, if that really holds. I'm not a huge fan actually of holding positions in Euro Swiss because I'm not a big fan of the euro still. That is one thing. Did you look at the euro dollar, Ryan?
Yeah, quickly. Yeah, I did. Yeah.
Oh, you did? Okay. So then let's move on to gold and silver. Yeah. Gold and silver. Well, yesterday I told you about this zone, right? 70, 85. Well, we went briefly into the zone and then bounced. But we are at 1996, guys. We are not back in the 2030s, okay? So this afternoon numbers, to be positive for metals, we need the yields to come back down. And gold could be the better one if the numbers are really crappy on as a package, okay? Gold could be a better one than silver because I'm still maintaining my overall view is that for silver to bounce, we need a bit of a weaker dollar. We need yields to come off as well, but silver has a different pattern than gold as well, right? We need economic data not to completely fall out of bed for silver to do well, as where this one could really be a kind of a haven if the numbers really start to be extremely crappy. Okay, sorry. So watch this zone on gold. If ever it starts to break below 1970, 72, then I think we're on our way to 40s. And then we need to reassess. Top side. Yeah, you know, it's 2000, 2010. And then if we get back above 2010, then we're likely getting back into this box again, 2015, 20 up to 20 and a half. Yeah, even 2060. Okay. So I think then this move is probably done and we're getting back into that zone. Silver. Yesterday, as I said on F.A.C.E, I think I had it, but just like really tiny. To my long-term stuff, I'm still waiting to see if we get anywhere in this bigger zone here to add more. But again, I would love economic data. They can be a tad weaker, but they cannot fall completely out of bed for this one to continue to shoot higher. Again, we are still in a massive consolidation phase to me. Long term, I still think we are going to go higher sooner or later. But we have to be extremely patient. That is for those who trade it long term. Last one to really want to have a look at is dollar yen. We could still be on our way to much higher levels, but as I said, that little overshoot of the 150.60 here, it's been undone, and then we're having that that setback in the dollar right now. This is a bit of a fragile one. I'm going to take it off. I think the more important ones are these prior highs, and then here this zone that I highlighted before, 78.6. So 149.4070 is my first zone of interest, and then it's probably going to be 148.80. Okay, that to the downside. If we start to move back above this 150.60, we have to take it into account, 150.80.90. But I think if we break back above, that means that the US data are still going to be very strong, and there's an increased chance we are going for a revisit of those highs. That's the way I'm looking at the dollar yen, especially not so much sterling anymore, but especially that a lot of those yen crosses are still trading at quite high levels and not giving back much, and every time they bounce, you know, Kiwi yen, Aussie yen, Euro yen even. Yes, we are trying to make a high here in the 161s, but we're still around that 161. We are not trading 158s, for instance. Okay, and with that, Ryan, over to you for today.
Thank you very much, mate. That's me done for the day. I'm hopping off for the rest of the day. Take the kids out. It's half term here. Got a few things planned, so you won't see me later. But I'll leave you in Kay's capable hands for those in the chat room, giving you updates on what the data is going to be doing, no doubt. Thank you, everybody, for coming to the Flow Show. Thank you, K-Man, for all your valuable insight. Have a great day,
everybody. Thank you, Ryan.
Cheers, mate. We will see you all tomorrow.